Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Brian Dangerfield, who is our US head of G10 FX strategy. Brian, we are kind of in the midst of a storm of conflicting headlines around the Middle East at the moment, and it is definitely a very kind of fast-paced and dynamically changing situation. So I thought we would take a different tack this week and actually get some insight from you in terms of what you're hearing from clients. I know you've been on the road in a number of different kind of continents lately, so I'd love to get your insight. I guess particularly what clients are actually telling you about the dollar.
Yeah, thanks very much for having me, Eimear. So just for context, over the last few weeks, done quite a bit of client travel to United Kingdom, Canada, and across the United States as well. And I think the general view on FX broadly, and this won't be surprising to any of our listeners who are active in FX markets, is that convictions are low and positioning is light, really across the board. That, as you mentioned, this dynamic, ever-changing situation in the Middle East continues to sap conviction. There are certainly sessions where the market trades with a much more optimistic tone, oil prices falling, long end rates falling. There were also periods where the markets were trading with a much more pessimistic tone, higher oil prices, higher long end interest rates. And I think that dynamic has really colored market thinking on foreign exchange, that there were certainly periods where we were hearing from clients concerns around higher long end interest rates globally, when 30-year yields, across jurisdictions were testing or in some cases breaching multi-year, multi-decade highs. There was certainly some greater concern around whether or not a real tightening in financial conditions would lead to a stronger dollar, whether that be via risk off or via an expectation of dollar inflows due to its reserve currency safe haven status, maybe seeing a bit more of a positive lean. But since those discussions, long end interest rates have rallied, have fallen quite significantly as oil prices have come back lower. And so I think that's really emblematic of the current environment that we are in, is that the market sees medium-term potential negative consequences for non-dollar currencies that come if the conflict in Iran continues and the Strait of Hormuz remains closed. But the market is also very aware that the situation could change quickly and is, in some senses, trading with an optimistic lean that if you were to get a deal that reopens the Strait of Hormuz in some pre-scheduled amount of time, that could lead to the market re-embracing risk trades and risk-on trades, which generally favor non-dollar currencies. You certainly see in some portions of the market, certainly in equity markets, that there's already signs that markets are embracing a much more positive risk backdrop, which tends to be negative for the dollar. So the broad point is that we have seen what we're hearing from accounts is a lack of conviction and low positioning that is light in general. In terms of the U.S. outlook, we've been hearing, I would say, mixed views. Some recent focus on signs of stabilization, particularly in the labor market. As you've seen, a couple of non-farm payroll prints in a row have been a little bit stronger than expected. Expectations that AI-related investment may be a more positive factor, and that as we've moved further away from the tariff-related shocks from last year, that maybe that we're moving away from tariff-related uncertainty as a negative driver. And so certainly some viewing the picture in the United States from a growth cyclical perspective, maybe looking a little bit better here. I think that fed into expectations that the Fed is likely to be on hold for the foreseeable future. That I think most believe that even with Warsh coming into the Fed chair position, that the Fed is unlikely to be moving interest rates anytime soon. On Warsh, certainly a lot of intrigue about his dovish influence on the Fed. We ourselves agree that Warsh will be a dovish influence on the Fed overall. But I think the way the market is maybe talking about that dovish influence has changed in the last couple of months since the start of the war. So before the start of the war, the conversation was that Warsh will come in and argue aggressively for rate cuts, and that would be his dovish influence on the Fed, would be pushing the committee to cut rates. The current iteration of that argument seems to be less about pushing cuts immediately and more about preventing the Fed from signaling hikes. So if the previous argument was Warsh will be dovish and push cuts, it now seems to be more like Warsh will be dovish by not pushing for hikes, which is different from many other economies where the market seems pretty confident that we'll get rate hikes. at least a rate hike from the European Central Bank in June. Bank of Japan looks like they may hike rates. Bank of England may not be far behind as well. And so some expectation for interest rate differentials to move against the dollar. But again, all of this is within pretty tight ranges and with light conviction, light positioning and low conviction.
Yeah, it does seem like the market, has priced in a lot of optimism when you look at kind of where equities are trading even. But I guess there is, as you say, always that risk that a deal could just come in one headline. I'm kind of curious to know what other kind of views of note have you heard from clients?
Yeah, so as we think across the G10, I think, an obvious one is UK and politics. And obviously, this is something that we've talked about a lot on this podcast is the resiliency of sterling in the face of multiple shocks, now both internal and external, whether that be from at times higher UK gilt yields, concerns around the political situation in the United Kingdom, but also the potential for energy related uncertainty, how the Bank of England feeds into all that with their somewhat hawkish disposition and their concern around inflation. We won't go through that whole story again. I mean, Paul Robson has been on this podcast quite a bit talking about that sterling resiliency. That was certainly one that was a frequent point of interest. Additionally, in Japan, continued expectations around the potential for FX intervention as dollar yen approaches the important 160 level once again. Some interest in the Bank of Japan and whether or not they would end up hiking in June or whether political influence around the timing of expected fiscal announcements may push that timing back further when taken in tandem with continued disruptions in the Strait of Hormuz. My sense is that the consensus is still pretty firmly negative on the yen, but very wary of being short the yen because we're in what I would consider the intervention sensitive realm. Our meetings predated the recent Australian data that was a little bit softer than expected. But in general, I think the position on Australian dollar, that's probably the most consensus long position, has come under pressure a little bit recently. But my sense is that that's still a view that is still generally liked, whether that be because the domestic economy has been strong. The RBA in Australia has already hiked a couple of times. It's put them closer to the top of the league table in terms of tightening and in terms of total policy rate, which is generally a positive for your currency when you have those higher front end yields. Last one to note, Canada and Norway, interesting in terms of the differentiation there in terms of currency performance. Norwegian krona has sharply outperformed Canadian dollar, even though both of those are energy exporters within the G10. And so both of them have had some positive developments in the terms of trade, but the currency reaction has not been the same. I think the big driver of that is probably monetary policy related. Bank of Canada has been relatively dovish, or Norges Bank has been on the other side. And additionally, USMCA and related trade uncertainty, I think, continues to hang over the Canadian dollar, which I think has been a source of weight, both on its domestic economy. You see their employment situation has weakened since the start of the year, and also some further concerns around whether or not there are risks to the Canadian outlook because of potential trade disruptions to the United States as we think about those USMCA renegotiation period. So I do want to change tact here, Eimear, and ask you a little bit about emerging markets and specifically China, because we no longer have the Trump-Xi summit to look forward to because that's already occurred. What are some of the other themes that you're watching in China now? Because we know it's such an important driver of not just EMFX, Asia especially, but of macro markets in general. What are some of the big themes in China that you're watching at the moment?
Yeah, Brian. So a relatively uneventful week for China. There was kind of a sole data print, which is industrial profits. But this one print actually gave us an interesting insight into these long-term dynamics which are playing out in the world's second largest economy. Industrial profits actually surged to a two-year high in China in the month of April, but it really contradicted with industrial output, which actually dramatically slowed in that same month. So it really shows you that the aggregate level, this was actually a case of price effects. It was mainly that, exporters, manufacturers, producers were able to increase their prices. Then we further drill down into the data in terms of what industries were actually driving that profit growth, you really uncover this kind of bifurcated two-speed Chinese economy. It was these new industries, these smart technology, high-speed technology, AI-related sectors, which were driving profit growth. For example, non-ferrous metals, which is a key input into AI, saw a 95% increase in profits. The electronic industry saw 108% year-on-year profit increase. That contrasts massively with China's traditional industries of clothing, apparel, furniture, which actually saw outright profit declines. So you do get the sense that kind of a transition is underway in China, where really they're kind of gearing up that value chain.
Super interesting to think about the consequences for global inflation if we see Chinese exporters maybe fighting a little bit more for profits here and maybe raising prices, because we're already dealing with a concordance of shocks on the goods prices side, whether it be from tariffs or from energy prices. If you get the sense that China's industrial exporters are maybe seeking greater profits at the expense of maybe raising export prices, that's something that's certainly notable as I think about the outlook for inflation across global economies. Did want to ask you, how does this feed into your views on financial markets and really across emerging markets and in China as well?
Yeah, I think this is kind of two key implications for Chinese policies. I would say, firstly, that, China, it's been well known that, they just continually are struggling with, very depressed, anemic domestic demand. But from the statistics, you can really see actually that they will be able to rely on really resilient external demand for this new technologies, AI industry exports. So to us, we've always in the camp where we don't think they're going to be very aggressive in terms of domestic policy, because they really do fear kind of ratcheting up debt again and adding to that debt accumulation. So for us, we don't think they will cut the official policy rate this year, and we're only looking for a cut in the reserve requirement rate by 25 basis points. So that kind of sets us apart from the consensus. I would say, secondly, the whole thing about this transition to a high value added manufacturing economy away from kind of the low value add, low skilled, is all to do with kind of profit margins. So traditionally, these low skilled manufacturing really operated on razor thin profits. But, if you're looking at high end AI related manufacturing exports, they're a lot more lucrative. It's a lot wider profit margin. And that means they're less sensitive to prices and they're less reliant on a weaker currency. So I think this kind of really feeds into the theme we've been calling on, is that the Chinese authorities will allow the yuan to appreciate, because actually the negative consequences for exporters will be so much less. I would also say, the kind of the themes underpinning our call for yuan appreciation are also that, they want to kind of internationalize the currency, so to make it a more powerful currency globally as people pivot away from the US dollar, but also because they have come in from long-standing criticism, not just from the US, but also from other Western economies, about kind of artificially depreciating their currency. And they would be worried about, being kind of, forced out of international export market or blocked from international export markets. So for us, we're looking for Daly yuan to trade 6.7 within the next 3 months. But Brian, that is probably all we have time for this week. Thank you so much for joining me. If you did like the podcast, please do remember to click like and subscribe so you get the latest episode first.